Imagine you're at a crowded theater and someone near the back quietly whispers, "I smell smoke." At first, nobody moves. A few people look around, nothing seems wrong. But then one person stands up, then another, and within seconds, everyone is rushing for the exit at the same time. Nobody stopped to check if there was actually a fire. The panic itself became the emergency. And the people who got hurt the most weren't the ones closest to the danger. They were the ones who ran the hardest without knowing where the exit actually was. That's exactly what a stock market crash looks like. And in this video, you're going to understand what actually causes one, what happens during one, how long they last, and most importantly, what you should actually do when the market is falling apart around you. Welcome to US Motivation and Growth, where we explain investing concepts in a simple way. But first, a quick disclaimer. This is not financial advice. All right, before we talk about crashes, we need to make sure we understand what the stock market actually is in simple terms. The stock market is a place where people buy and sell small pieces of companies called shares. When a company does well, its share price usually goes up. When it struggles, the price usually falls. Now imagine millions of people doing this every single day across thousands of companies. The overall direction of all that buying and selling is what we track through indexes like the S&P 500 or the Dow Jones. When those indexes fall sharply and quickly, that's what people call a stock market crash.
But here's something important. Not every drop is a crash. Markets go up and down constantly. A normal pullback might be 5% or even 10%. That happens all the time and it's completely normal. A correction is when the market falls around 20% from its recent high. A crash is something sharper and faster. It usually happens over days or weeks, not months. Prices fall dramatically. Fear spreads quickly, and the news makes everything feel like the world is ending. Understanding this difference matters because most people treat every dip like a disaster, and that's one of the most expensive mistakes an investor can make. So why do crashes actually happen? There are a few core reasons. The first is overvaluation. Sometimes the market gets too optimistic. Prices rise far beyond what companies are actually worth based on their real earnings and fundamentals. This is called a bubble. Everyone is buying because everyone else is buying, and for a while, it works. Prices keep going up. Confidence keeps rising. But at some point, reality catches up. When investors realize prices no longer reflect actual value, selling begins. And once selling begins, it can accelerate very quickly. The second reason is external shocks. Sometimes a crash is triggered by something completely unexpected: a global pandemic, a war, an energy crisis, a banking collapse. These events create sudden uncertainty, and markets hate uncertainty more than almost anything else. When the future becomes unclear, investors stop buying and start protecting. Capital moves out of risky assets fast. The third reason is leverage and forced selling. Many investors and institutions borrow money to invest more than they actually have. This is called leverage. It amplifies gains when markets rise, but it also amplifies losses when markets fall. When prices drop, leveraged investors are sometimes forced to sell positions quickly to cover their losses. That forced selling pushes prices down even further, which triggers more forced selling. It becomes a loop. The fourth reason is psychology and panic. This is probably the most powerful force in any crash. When prices start falling, fear spreads, and fear makes people irrational. Investors who had a long-term plan suddenly abandon it. They sell not because the fundamentals changed, but because they cannot stand watching the number go down. That collective panic creates a self-reinforcing cycle, just like the theater. The selling causes more falling, which causes more fear, which causes more selling. Now let's talk about what actually happens during a crash, so you know what to expect if you ever live through one. In the early stages, prices start falling, and most people assume it's temporary, a healthy correction. Then the news cycle picks up. Headlines get louder. Words like bloodbath and collapse start appearing. Social media fills with people predicting the end of the financial system. At this stage, the emotional pressure on investors becomes enormous.
In the middle of a crash, volume spikes. Millions of shares change hands as panic sellers try to exit, and opportunist buyers start watching carefully. Volatility explodes. A stock can fall 5% in a morning and recover 3% by the afternoon. This is the most dangerous moment for most investors because the noise is at its loudest and the temptation to do something, anything, feels overwhelming. Then comes the bottom. And here's the frustrating truth about the bottom. Nobody rings a bell when it happens. You will not know it was the bottom until the market has already started recovering. This is why trying to time a crash perfectly, selling at the top and buying at the exact bottom, almost never works, even for professional investors. So, what should you actually do? This is where most finance content gets vague. Let's be specific. The first thing is to do nothing if your investment timeline is long. If you invested in a diversified index fund and you don't need that money for 10 or 15 years, a crash is painful to watch, but it does not change your outcome. Every major crash in history has eventually recovered. The S&P 500 recovered from the 2008 financial crisis. It recovered from the dot-com crash. It recovered from the COVID crash in 2020. Doing nothing during those moments was often the right move. The second thing is to avoid checking your portfolio obsessively. This sounds simple, but it's one of the most effective things you can do. The more you watch the numbers fall, the more emotional you become. And emotional decisions in investing almost always cost money. Set a rule for yourself during volatile periods. Check once a week, not 5 times a day. The third thing is to make sure your emergency fund is in place before you invest. A crash becomes a personal disaster only when you are forced to sell. If you lose your job during a recession and your only money is in the stock market at a 40% loss, you have no choice but to sell at the worst possible time. But if you have 3 to 6 months of living expenses in cash, a market crash becomes something you can simply wait out.
If this helped you see money differently, hit that like button and subscribe because I break down money in a way that actually makes sense. I'll see you in the next one.